Hello and happy new year from TrueView Financial. Hope you had a great holiday season. This is going to be a quick recap of what investment markets have done in 2023, 2022, how your accounts have done, how it has affected you, and what we can look for going forward. All right, so when you start looking at the news, you're probably going to start hearing about what's called the Magnificent Seven. So let's take a look at the wild ride of the investment markets over the last 2 years, 2022 and 2023. So 2023 was a year of major growth from large technology companies, companies like Apple, Amazon, Microsoft, Tesla, Meta, which is Facebook, and Google, and then big time NVIDIA. So NVIDIA, for example, they started manufacturing all the technology chips, and they had a major increase in their stock price in 2023. So large growth technology companies way outperformed in 2023, and specifically this Magnificent Seven that you're probably going to hear a lot about. But what's really interesting, while those companies did amazing in 2023, those same seven companies in 2022 had major losses. And then most of them are not even back to even after their amazing gains in 2023. So if we look back from 2022, 2023, of these same seven companies, they're all still actually in the negative. So even Tesla had an amazing year in 2023, but when you add in the last 2 years, it's still negative. NVIDIA is the only company that's been positive of those Magnificent Seven. So again, this is really important to look at not things just with recency bias of what just happened recently, but how did it do over the last couple of years? And it paints a much more clear picture. One of the other things that's happened in the most recent years is growth companies have outperformed value companies. Now, since 1975, that's happened six times. And three of those times are basically since COVID, since 2020. But what's really interesting is when those growth companies outperform, the next month to year, they significantly underperform their counterparts, which are considered value companies. Now, this is really important specifically for you in the way you are invested. So we put together based on academic research, based on Nobel Prize winning theories from people like Eugene Fama, who's considered the father of modern finance. They won a Nobel Prize in 2013. And one of the things they found is that to increase your higher returns is to invest more in stocks, invest more in value companies, and small companies. Over the long run, you can see they have outperformed, right? So compared to where we have been in the last 3 years, growth companies outperforming. Also, it's really important to know that stock picking and market timing has very little impact on your overall performance. So what you want to get from this is you want to remain diversified. You want to remain committed to your current strategy over the long run. You don't want to let short-term fluctuations or very short-term trends like we've seen in those large technology companies influence your investment strategy. All right, so and here's the reason why. Let me paint a clear picture for you. Here is all the major indexes for the stock market. So Dow Jones and S&P 500 are recognized as indexes for the large companies in the United States. NASDAQ is basically technology companies and large companies in the United States. This is small value companies. These are international stocks. Emerging markets are smaller, less developed countries like in India, US bonds, international bonds. Here are your actual investment accounts based on your investment philosophy, how much risk you're willing to take. Here's the actual performances of like your accounts and those indexes. So you can see in 2023 is, for example, technology companies did really amazing. And everything was positive in 2023. But look at 2022. is everything was negative. 2022, we can't forget about. That was the worst year in the stock market since 2008. It was actually the worst year in the bond market in the last 30 years. So here's how your investment accounts performed, again, based on your philosophy and how much stocks positions you're holding. This losing less than basically everywhere else is a direct correlation to the diversification that you have, your management, and your rebalancing that we automatically do for you. So that's proved to work. And when we take in the last 2 years, I know this isn't a great number. We want to see that be 10%, 12%, but it's outperformed almost every single index over the last 2 years. Again, this is the benefits of looking at things over the long run, not just the short run. And I want to give you another example of that because very, very important is this. We want to learn from history. And back in like 2000 to 2010, let me just blow this up a little bit. The best stock fund was a CGM Focus Fund. And from 2000 to 2010, it was up more than 18%. That's if you stayed in. Now, again, I'm going to show you why you don't want to market time and why you don't want to follow for the short-term trends. Is over that same time frame, while this fund was up 18% on average per year, the average investor who invested during that same 10-year time frame actually lost 11% per year. So the investment was up 18%, but the average investor actually lost 11%. And that's because they followed the short-term trends. When the investment went way up, everyone got in. When the investment went down, they took the funds out or changed their investment strategy. Then when it went back up, they got back in. So they kept missing the returns. So what I want to share with you is most people do that. You're going to hear a lot about right now people, you got to get in the U.S. Investments. You have to get in large companies. You have to get in technology companies because they perform so well in 2023. Well, on average, when people market time or follow that news that's ever changing, is on average, people are performing significantly less over the long run than the average in the market. So you want to be up here and getting what the market is giving you, not chasing returns, not chasing short-term trends, and things like that. Again, this is the best quote I found about how to have a successful investing experience right here, is that the markets go up and down. You want to stay committed to your investment strategy, stay the course, remain a long-term smart investor, diversify, rebalance, have some management. If you have any questions about this, I want to make this short, fast, so it doesn't take up too much of your time. Please feel free to schedule a time on our calendar. I'm happy to review this and your specific performance and outlook for 2024. Again, Happy New Year. Hope you and your family are happy, healthy, and I really look forward to working with you this year and beyond.